Stocks and bonds are the meat and potatoes of investing. Steady, reliable, and filling. But alternative investments, that's the truffle fries and caviar. Flashy, different, and not for every plate. Hey everyone, Tommy Derfler and Sam Rice here with Lighthouse Wealth Group, the Spotlight podcast. And so in today's episode, we're digging into the world of alternative investments. What they are, how they differ from traditional markets, why people invest in them, as well as just the unique risks they carry and where they might belong in your portfolio. So to kick us off, here's a fun fact. In 2023, global alternative assets under management hit about $13.7 trillion. And analysts expect that number to grow to nearly $23 trillion by 2028. That's a lot of caviar. Let's dig in. All right. So when we talk about, alternatives, the first thing we have to talk about is basically, what are they? And so to start off the podcast, one thing we say is, it's basically anything outside the world of traditional stocks and bonds. First thing is, if you think of real estate, that could be commercial or residential real estate. That is an alternative investment, right? So in our world, stocks and bonds typically go like this with each other, right? When stocks go up, then bonds typically go down. And when bond values go up, typically stock values go down. So, a lot of these alternative investments do not go in those same directions, a very predictable direction. And so if you look at your own home, if you own a home, that's not going to go up and down in the same way that stocks and bonds do with each other, and so real estate is considered an alternative investment because it just doesn't follow those same patterns that traditional stocks and bonds do. And the same thing, in the commercial side of real estate as well. So, the commercial real estate market has about $20 trillion with about $1.3 trillion in real estate investment trusts, which are essentially commercial real estate kind of bundled and packaged together in the form of a mutual fund. So, but real estate is one type of alternative investments. The other type of alternative investment is going to be things like private equity and venture capital. Obviously, private equity is just what it sounds like. It's the opposite of public equity. So when you look at the S&P 500, those have 500 companies in there that are all publicly traded companies. But that doesn't mean that all the companies in the United States and overseas are all publicly traded. They're not. They're private. And so private equity is a form of alternative investment. And then the same thing with venture capital. And so venture capital are companies that invest in startups. A person has an idea, but they don't have the capital to get that idea off the ground and running. So typically a venture capital firm will come in and say, hey, we'll give you the capital. We want to know your business plan. We want to know your ideas. We want to know everything about your company that you're starting. We'll give you the capital in exchange for a portion of equity inside the company. So, private equity and venture capital alone are about $1.1 trillion as of 2023. So these are big, growing, industry and growing companies in these industries. Hedge funds, that's also considered an alternative investments. They're about $4 trillion worldwide in from 2023. And then another alternative investment is simply commodities. Commodities, I always explain, are things that you can grow, live off of, hold in your hand. So you think of wheat, barley, corn, and gold, silver, any kind of minerals. All those are also considered an alternative investments. And so what's also considered are collectibles, right? So things like artwork, watches, any kind of those collectibles that are probably more known for being passed down to the next generation. But obviously you go to New York, there's a lot of collectibles. There's a lot of art there. Go to Paris and there's a lot of art being traded. And so I'll never forget, I remember watching a documentary, and I think it was the band Metallica and the drummer there, me being a drummer. I'm always interested in hearing other drummers. But, he made a comment and said, everybody puts their wealth in the bank. I put my wealth on my walls. And he was referring to artwork, of course. So I thought that was just kind of a unique statement. I never heard that before. Instead of putting my money in the bank, I put it on my walls of my home, and so on. But I thought that was pretty interesting. So I just say this to say that, hey, this is a very growing industry. This is obviously be growing topic amongst a lot of people. And so they're not really the sideshow anymore. They're a multi-trillion-dollar business that's coming more towards the forefront. So really interesting stuff here. But I think, Sam, what makes these things so different than publicly traded companies?
Yeah, good point. Good question. So there's really three different things that I would say separate these from your traditional public stocks. It's their liquidity, their reporting transparency, and their exclusivity and access for investment. So really what this means is a couple of these factors make it a little bit harder to invest for the average person. So that's one of the reasons why it's a little bit harder to become an investor for some of these funds. They require some of these thresholds to be met as an investor for you to put your money in them. So I'll go over that first thing first, access. So only about 13% of all retail investors qualify for what's called an accredited investor. So that means you've got a certain income or a certain net worth that allows you to be able to invest in some of these alternative investments. Since they are less traditional, one of the things that they essentially make as a requirement is that you know what you're getting yourself into. So there's additional forms to sign. And then, like I was saying, additional net worth requirements and income thresholds to meet to make sure that, you're not putting all your eggs in one basket. Because one of the tricky things with some of these alternatives, and in most cases, they require, which leads into the second thing, liquidity. They require a lockup period of your funds for a certain amount of time, whether that's 2, 5, 7 years. Your initial investment that you make, sometimes you can't get that back legally until a period of time has been met. And they may be, offshooting dividends or profits to you in the meantime. But all of those things are known on the front end. Again, makes it one of those big differentiators from a public stock, right? Something that you can buy and sell essentially within the same day. You can't do that with these alternative investments in most cases. And then the third thing, transparency. So typically when you think of stocks and bonds, right, these are based off very large companies. Many of them, say the S&P 500 biggest companies in the US. And so there's pretty big thresholds for reporting to even get to that point and be publicly traded. This means anyone can buy you, anyone with a retirement account or a brokerage account can really be a part of your company, where these companies, as an alternative investment, they have higher minimums to invest. They require you have more money in the bank and or a higher income. That means in their mind that you have a better understanding of the investments that you're getting involved with.
Right.
The liquidity is less, right? You can't just buy and sell these within a couple of days. They have legal
Sam, why is that?
Yeah. So very good question. So, right, one of the benefits to some of the publicly traded companies is that they're big enough to write stock, to create stock. And that's one of the benefits of going public, right? They IPO, they can sell stock to retail investors on the public market. And in many cases, these private companies, whether it's a fund, like a hedge fund, that's essentially its own little company that's doing investing, potentially in public companies, but they're doing so in a maybe a leveraged format, or they're investing in private equity, which is investing in private companies that maybe aren't big enough to be listed directly on one of the big indexes. That's typically, I would say, one of the biggest differences with the liquidity and the lockup, or they've accumulated a large amount of money that their plan is. This is a good example. So say a private equity fund or even a hedge fund, they're accumulating a large amount of money to allocate over a period of time. They have a mindset of the investments they're looking for their target portfolio, right? The portfolio would have guidelines that they're investing in, a certain type of company, what have you. But they may not have that found yet. They may not have found that company yet. So they're pooling a bunch of money together to make those acquisitions over the next couple of years. So that in many cases is why they've got a lockup on that bulk of money, because they're going to pile all that money together on the front end, and then over the next couple of years they need it to be kept within that fund so they can make those acquisitions. And then as the years move on, they can either structure all those companies together, maybe sell them all as a bundle later on. That's one of the big ways in which private equity companies make money, or they bundle them all together, they kind of restructure them and just increase operational efficiencies, so where their investors are, say, getting like a dividend of the profits. So where that benefit has come from.
Yeah, it's so, because they're private, not everybody knows there's a secondary market to that. You know what I mean?
Exactly.
It's so if you don't have a secondary market to that makes that liquidity issue a bigger issue, because, for Google, for example, they're so big. If you decide to sell your one stock of Google, somebody's going to buy that because they're so big. Somebody's going to buy it. So that market and that liquidity is always there because it's so readily available. But what you're saying is because of private equity and alternative investments, such as art or, your great-great-grandfather's gold watch. Well, how do you really determine how you can't really liquidate those things, and if you don't have a ready buyer at any given moment? Exactly.
Or maybe there's a set max of buyers that they will even allow to make those investments, right? Typically what happens is, right, if a private equity fund is asking people for money, once they hit that threshold, their goal, they're not taking any more investors. They've capped that. So that one team is going to be, making their investments over the next couple of years, and the next team will be structuring the next fund.
Well, in your case, what you're referring to is a private equity fund, right? It's someone who goes out specifically looking for a bunch of private equity companies. But if you just take out just the fund and say, hey, a privately held company, that's just one company privately held. It's like the mom and shop bakery down the street here. Yeah. That's private equity, right? That's somebody who's the owner that says, hey, we own this business. We're sole proprietors or we're partners. That's private equity. And so for just the listeners today, to give you a concept, what Sam's referring to is private equity funds, which are saying, hey, get a bunch of people together, pool their money together to go out there and buy those mom and pop shops, all around, the state, your state or the country or whatever it may be. And so there's two parts to that. One is just a private equity saying, hey, this is just a non-public company. And then there's a private equity fund, which is building your own mutual fund made up of non-publicly traded companies, private equity.
Yeah. And the same thing for venture capital, right? And a lot of times they're doing similar things, but for venture capital, it's early stage companies that are typically smaller, but they're shooting for really high growth. down the
Yeah.
road.
And so just for the listeners here understanding too, the Trump administration has really actually just a few weeks ago laxed a lot of those things that Sam initially talked about, saying, hey, you've got to be this accredited investor, right? And that was really there to make sure that people aren't just willy-nilly about this and they know what they're getting into, and so, going back to what you were saying earlier, the transparency isn't always obviously right in front of your face with privately held companies.
Yeah, that's right. And that is probably the biggest differentiator. Right. Because some of these funds could be investing in, say, 20 different, as an example, plumbing companies or HVAC companies. Yeah. Right. It's going to be really hard for them to culminate all these reports together. They don't have a huge company with a back office accounting staff to make those reports available quarterly for their investors. You may get some reports quarterly. You typically do, but it's more on the fund itself and the health of the fund rather than the companies individually that they're investing in.
Yeah. That's great.
And anyway, and then again, just the access. So, the stress for alternative investments is just having the investors and the clients as retail investors understand what they're getting themselves into. And that's why they've kind of set typically a higher bar for some of these non-public investments like alternatives. But obviously we've talked a little bit about the differentiators, but what's some of the big reasons why people invest in these, Tommy?
Yeah, I mean, so if you think of it on a very, very basic level, something different, right? Mm-hmm. So everybody's looking for just something, and I think this is just something different. And it depends on your level of sophistication or simplicity or whatever you might be looking for specifically. But, I think the biggest reason is simply just diversification. Hey, there's something else out there that does not go like this when stocks and bonds are moving in these type of directions. It's just something else. So, you can have something that doesn't necessarily correlate to stocks or bonds, and so that's kind of a good buffer within a portfolio. So, you take certain things, obviously when interest rates went up and skyrocketed very quickly, well, bond values went down very quickly, right? And so you may want some kind of diversification to say, hey, when interest rates go up, I don't want the alternative investment to go up or down. It may just say stable. It might not even have an effect on some of these things that we just talked about. And that's what people like is, okay, it does not have an effect one way or the other. So just saying, hey, not putting all your eggs in one basket. Well, alternatives do provide another kind of basket. And so it's just an additional basket there that says, hey, there might be some things over here that are really kind of going up and down, but this might be staying very, very stable at that time, or this might be growing when things over here, are going down. So, I do think it provides just something different that's people can say, okay, hey, great. There's more diversification and I don't have to put all the eggs in the publicly traded companies, as well as the bonds. The other thing is just inflationary hedge. So there's certain things out there that do help with inflation, and gold is one of them, of course. And so in the 1970s, we had one of the worst inflationary decades in U.S. history. Well, guess what gold did? It rose by over 2,000% while the market lagged. So, and full disclaimer here, we're not saying that gold's better than publicly traded companies. We don't believe that. So please don't, that's not the takeaway of this, but the takeaway is that these things do go up at certain times and down, but they can be, obviously gold is something that people flock to a lot more when there's fear in the economy for whatever reason. And so that could be an inflationary hedge of saying, hey, if there's, a lot of inflation, then we can go and buy gold. And that's when gold typically does well. So, Again, not saying that gold is the best investment. Don't want to convey that, but there are certain hedges that you can have by having some of these things that might do well when others aren't. And then I think this is kind of the flashiest part is return potential. So venture capitalists, everybody now says, man, I would have loved to have gotten in on Google before it was Google. I would have loved to gotten into Meta and Facebook before they were Facebook and then eventually Meta, or Amazon. Everybody loves hearing those stories of when these companies very first started. And so venture capital specifically, that's what they're trying to do. They're trying to find, the next big thing. And they're taking the risk to do that. They're taking a lot of risk. And so sometimes people just want to find that next big thing. They kind of want to, speaking of gold, strike gold, so to speak, and so they're trying to find the next Google. They're trying to find the next Amazon in these venture capitals and say, hey, if we can give you a certain amount of money and we get that equity in exchange for that, because, Google made nearly 5,000% returns by the time of its IPO. You don't hear those things with publicly traded companies after they become, publicly traded. There's usually stability of this. But quite frankly, people want that. They want to try to look for, the next big thing. And so they're going to look at things to try to determine, hey, I'm hoping that this is going to be the next big thing. Let me try, putting some money towards that. Which is circling back around why, there still is and there was accreditation involved in this because they wanted to make sure, hey, we don't want to go back to the 1920s where everything was, the Great Depression and so on. And, there was no regulation. And so that doesn't help anybody. So there are these things in place to kind of help the average person, know what they're getting into. And so, but I think that's, to your point or to your question earlier, which is, hey, why do people invest in alternatives? Well, it's a lot of people say, hey, I want to take the risk. I want to look for the next big thing, and I'm willing to see my money go up and down, or not have as much transparency, or maybe I don't know the value right away, and I only get the understanding of the value once a year in a lot of cases. So that's they want to go after something that's a little flashier by design. And I think that's one of the biggest lures that, do attract people to certain alternatives. So
that's right.
But, I'm kind of alluding to, there is a risk factor to this. So, in our world, everybody knows higher risk, higher returns. But higher risk and potential flops as well. So Sam, talk to us about, kind of walk through why there's that risk associated with some of these things.
Yeah. And again, these all connect to each other, right? There is enhanced risk to a lot of these alternative investments. And they really base off some of the differences between public and private assets, right? The liquidity, maybe something may happen in the economy and your money is contractually locked up with this private investment for maybe another year or two, and you just can't get it out, and something's changed within the landscape that really does a number on the stuff that they're investing in. So liquidity, 85% of private equity funds have your money kind of locked up for 5 to 7 years. So that inherently is quite a big differentiator of risk than most public companies, where, right, if I bought Google, we've been harping on Google a lot, but it's an easy example. If I bought Google today and, next week they had something changed in their earnings report, I could sell it the next day, right? I can get out of it. Maybe I'll lose a couple percentage points or whatnot, but I can get out, no harm, no foul. Where this, man, you're in for the long haul. So in many cases, with that outsized risk, right, we can potentially achieve higher returns, but we can also have that money just potentially be evaporated if something changes within the market, within your time horizon. And so what we see a lot of people is making many of these smaller investments for higher returns, not putting all your eggs in one basket, right? Because another one of the tricky things with some of these private companies is if they don't have public accounting report records, the valuations can be very, very different over the years, right? If, maybe one of their acquisitions changes, the market landscape changes. So in many cases, these private equity funds can have 10 to 20% valuation differences throughout the year, just depending on what may change within the market landscape, right? We've got interest rates are a big hot topic right now, and that could certainly change, a lot of these less liquid assets, right? If they're based off borrowing money, that kind of thing going in the future. And then for like hedge funds, one of the outsized risks for them is in many cases they use leverage, which is essentially buying stock on credit. So if you've got, a $50 million portfolio, maybe they're making $70 million worth of purchases because they're using leverage. So in some cases that can allow you to have outsized returns because you're using more money, and say 5% gain on $70 million is bigger than 5% on 50 million, but it can also definitely go the other way around, right? If that position or strategy goes the opposite way, sometimes you need to be protected. It can keep you get you caught with your pants down. And as opposed to investing in a regular index, which is usually a wide variety of companies, typically over 50, 100, or the S&P, which is 500. These are much more specialized and typically fewer amounts of companies that they're investing in. So maybe 10 to 20 companies that they're directly making investment in. So a smaller amount to broaden that risk across with those companies that they're investing in, rather than a very broad index. So I would say one of the biggest differences is, right, they've got concentration risk, but that's in many cases the purpose of these investments is to be very concentrated in their investment, where in most cases, their average retail investor is using that diversification to their advantage, because they don't either have the specialty knowledge or the resources to make those informed investment decisions. And the indexes perform very well. So there's nothing wrong with that at the end of the day. But in many cases, these people are looking for understanding their risk and making investments, understanding that for outsized returns, hopefully in the future. So this leads us to, where do they belong in a portfolio? You have to be an accredited investor, typically, is the minimum bar for a lot of these. There's also qualified purchaser, qualified investor designations. But where does this come to the average retail investor? Where does this fit in their portfolio? So typically where we say, an average 60-40 portfolio, that's going to get either 8 to 9% return. A lot of times people can make a alternative position with about 10 to 20% of their portfolio if they meet those requirements. What we're seeing in a lot of high net worth investors is typically they range in about the 25% realm of alternative investments, looking for that non-market correlated return, whether that and might be a hedge fund.
Just to interject here, they have a higher percentage of that because obviously they have more money they can put at risk.
They have more money,
right?
Yes.
So there's a big difference between having a net worth of $1 million and then putting $100,000 at something, right? 10% of your net worth. If you put in something super high risk and it flops, that's going to be pretty detrimental to you, right? Whereas if you have somebody with a net worth of, let's say, $100 million and they put $100,000 towards investment, that's not going to change their lifestyle whatsoever.
Correct.
So their whole tolerance of risk goes up.
It's very different.
Yeah, exactly, for a high net worth person rather than the average, retail investor.
Yes, no, that's a very good point. And I'll also go to say, right, if their overall makeup is around 25% alternative investments, that's not going to be in one, right? They're going to be sprinkling that risk of alternative investments around multiple investments, investment types, investment categories, to just add further diversification, right? Because each of these alternatives is going to be very specific in what they're investing in, the returns they're trying to achieve, the benefits they're trying to achieve. Sometimes there's really good tax benefits to these. But again, right, if somebody's worth $10 million and they've allocated $2.5 million towards alternative investments, since the minimums are higher, the average retail investor, like you were saying, maybe they could qualify for an alternative investment, but that could take up just the minimum requirement of investment could be $100,000 or $200,000. That could end up being 10 or 20% of their entire net worth.
Yeah.
Right. For that one investment where they're sprinkling the risk around.
That's right. So, yeah. So I think it's basically what I hear you saying is, listen, it can be part of the main course of your dinner, but it's not to be the main dish. It needs to be a side item. You know what I mean?
Yeah. Because think of it again, right? A lot of these funds, not only do you have to qualify, you have to have a minimum investment to even get involved, which is typically at least $100,000. So,
just in closing here, I know we're running out of time, but I think what we wanted to make clear in this is just kind of providing listeners just education. This is obviously a multi-trillion-dollar industry as far as alternatives go, and it's probably going to be growing. And I think what we've seen as advisors on our side is a lot of these things. One, you have regulations laxing a little bit, just like we talked about earlier. The Trump administration has laxed some of these requirements, and then they're actually packaging these up to be more available for the retail investor. So all the things that we just discussed, I think the industry is trying to say, hey, how do we do this in a way that we can actually provide these alternative investments to the average retailer, but at the same time kind of protect themselves from themselves. And so it's it's just like anything. We always tell people, hey, just, these carry unique risks. They're very different. We're not trying to say they're for everybody or they're not for anybody. The answer is probably in the middle somewhere. But the bottom line is it can, strengthen your portfolio. But at the same time, there's very unique risks that come with this. And so, again, every time, if you really want to sound smart and professional, just bring up private equity in the dinner table or at the dinner conversation, and that's what everybody wants to do is they just want to be able to have that conversation because it's flashy right now and it's cool and it's hip. But, please, we ask, do your due diligence, make sure you know all of the unique risks involved. But, we just know it's not going to go anywhere. It's a growing industry. So we just want to thank everybody for being here listening. Please, if you enjoyed today's episode, subscribe, share it with a friend. And remember, investing is about balance. You build the basics first, then decide if alternatives have their place in a portfolio to add to your financial menu. But I'm Tommy Derfler, Sam Rice, Lighthouse Wealth Group Spotlight Podcast. Thank you, and we'll see you next time.
See you then.